Okay, let's dive right in. The market has been all over the place, and I know a lot of us are feeling that anxiety. But today, we're digging into a really interesting article from the Financial Express. It lays out a very specific step-by-step strategy for finding opportunity right in the middle of a market downturn. It's called the Bold Bulls Strategy.
So the article starts with this classic saying from the markets. You've probably heard it before, right? It's totally counterintuitive. The idea that when all the news is terrible, that's when the market actually hits rock bottom.
Whoa, hang on a second. I get that in theory, but in practice, when you're watching your portfolio just plummet and every single headline is doom and gloom, your gut is screaming, sell, get out, not, hey, time to go shopping. It feels like you're trying to catch a falling knife.
And you're not wrong to feel that way. That panic is real, and the article gets right into why. It talks about things like rising crude oil prices, geopolitical tensions. All of this stuff is creating these massive worries about inflation and what it means for the economy. It's not just a local thing, it's everywhere.
And that anxiety, it isn't just a feeling. You can actually see it in the numbers. The article points to a recent Monday when traders on Dalal Street just got hammered. The Nifty 50 opened with a huge 700-point drop. I mean, a number like that is pure fear made visible.
Exactly. So even if you do kind of buy into that whole bottoms are made on bad news idea, what are you supposed to do? Just close your eyes and start buying whatever's down the most? As the article puts it, that's like throwing darts blindfolded. You're probably just going to get hurt.
And that's the crucial point. The panic is emotional, but the answer has to be systematic. This is where the whole conversation shifts from, wow, things are scary, to, okay, here's a plan.
So let's talk about the opportunity. The author makes a really interesting point. Instead of looking at the usual big-name, large-cap stocks, maybe the real potential during a recovery is in small caps. They tend to get hit harder on the way down, sure, but they can also bounce back much faster on the way up.
And this isn't just a hunch. There's some data behind it. The article points to this chart, which is a ratio comparing the small cap index to the Nifty 50. Basically, when this line goes up, it means small caps are doing better than large caps. And right now, it's showing signs of bouncing off a floor and starting to head up. It's a clue that the market's leadership could be shifting.
Which brings us to the heart of this whole thing, the Bold Bulls strategy itself. And let's be clear, this is not about trying to perfectly time the market bottom. Nobody can do that. Instead, it's a framework, a system for spotting stocks that are already showing incredible strength, even when everything else is falling apart.
The whole strategy really boils down to 3 simple, hard and fast rules: how you get in, how you manage your risk, and how you get out. So let's start with rule number 1, the entry. The goal here is to find stocks that are firing on all cylinders, showing powerful momentum across different time frames all at once.
Okay, so the article starts talking about something called the RSI. For anyone out there who isn't a chart wizard, what exactly is RSI? Great question. The easiest way to think of the Relative Strength Index, or RSI, is like a speedometer for a stock's price. It tells you how fast and how strongly the price is moving. For this strategy, you're looking for a reading over 60, which basically signals that there's a ton of buying interest pushing that stock up.
And here's the real secret sauce. It's not enough for the RSI to be high on one chart. For a stock to be a true, bold bull, it needs to have an RSI above 60 on the monthly chart and the weekly chart and the daily chart. When all 3 line up like that, it's a powerful sign that the strength isn't just a blip, it runs deep, from the long-term trend all the way down to what's happening right now.
All right, that's the entry. Makes sense. Now, what about the risk? The article says you set a stop loss at 15% below where you bought it. 15%! Man, that feels like a pretty big hit to take. It does, but discipline is everything here. In a choppy market, and especially with these smaller stocks, things can swing wildly. You have to give them a little room to move. A hard, fixed 15% stop loss is a rule you set before the emotions kick in. It defines your maximum pain point on that trade, period. It's what keeps one bad bet from blowing up your account.
And just as important as knowing when to cut your losses is knowing when to take your wins. That brings us to Rule 3, the exit. The strategy uses a really clear 2-part system for cashing in your profits.
Oh, I like that. That solves that classic problem, right? The, should I sell now and maybe miss out, or should I hold on and risk it all falling back down? It's agonizing.
Exactly. And this takes the guesswork out of it. The plan is simple. Once your stock is up 35%, you sell half. Boom, you've locked in a solid profit. Then you let the other half ride, and you only sell it when it hits a 50% gain. This way, you make sure you get paid, but you still give yourself a chance to catch an even bigger move.
So that's the entire framework.
But the big question is, what kinds of stocks does a system like this actually find in the real world? Well, the article did the work for us. It ran a scan of all the companies in the nifty small cap 250 to see what met these really tough bold bulls criteria.
Okay, so here's the list. Anand Rathi Wealth, Data Patterns, JB Chemicals, Kirloskar Oil Engines, and Psy Life Sciences. That's an interesting mix. So, is the article saying we should all run out and buy these stocks tomorrow morning? No, absolutely not. And this is probably the most important slide in the whole deck. The article could not be more clear about this. This list is not a buy list. It's just the output from the scan, and we're showing it here for educational purposes only, just to see how the system works. As always, you have to do your own research and talk to your own advisor.
Got it. Okay, so the names on the list aren't the point. The process is the point.
You nailed it. That's the entire takeaway from this article. Market crashes are designed to make you panic. They trigger fear, greed, uncertainty, all of it. The key is to have a process that overrides those emotions.
This slide just sums it all up, doesn't it? It's about making a conscious choice. Instead of acting out of fear, you follow your rules. Instead of getting greedy, you rely on discipline. You literally replace panic with a strategy and replace that feeling of uncertainty with a system. It's about taking the emotion out of a situation that is packed with emotion.
You know, I think the big insight for me is that even when the whole market gets dragged down, the truly strong companies, the ones with real momentum behind them, tend to bounce back first and fastest. Like the article says, strong stocks just don't stay down for long. This strategy is just one way to try and find them. And ultimately, that's the question we want to leave you with, because we all know there will be another downturn. It's not a matter of if, but when. So when it comes, are you going to get swept up in the panic with everyone else, or are you going to have a disciplined process ready to go? Definitely something to think about.